debentures.
Okay.
So for debentures, we said a debenture is a type of debt instrument issued by companies and government to raise capital which is not secured by physical collateral rather than reputation of the issuer. So a debenture is a long-term finance, but it is issued by either government or companies when they need to raise capital.
Yeah.
But it is not with collateral. You don't need the collateral to issue a debenture. All you need is your reputation and your credit worthiness.
Okay.
So if you have a good reputation and you have credit worthy, you can issue a debenture. So for debenture holders, these are people that have money that wants to loan you for a long period of time. So what are the features of debentures? Number one, unsecured debts. It is unsecured because you don't need the collateral.
Yeah.
Two, credit worthiness. The issuer financial strength is needed.
Yeah.
Your financial strength is needed. That is your credit worthiness.
Okay.
Fixed interest. You have to pay a fixed rate of interest because you are taking a loan, so you have to pay interest on it.
But it cannot change?
No, it's fixed. They call it fixed.
Okay.
It's fixed. The investor role. Investors who purchase debentures investors who purchase debentures become a creditor to the company.
Yes.
So because you purchase debenture or you purchase a debenture, you mean you will be treated like a creditor,
Not a shareholder.
not a shareholder.
Okay.
We got that. Then the last thing is the purpose. Why do we issue debentures? We issue debentures probably for long-term financing in terms of expansion or maybe a project. That is why we issue a debenture. Do you get it?
Yes.
Shares or debentures.
Okay.
So what are the difference between a share and debentures? So we're going to look at the advantages and disadvantages. So I'm going to read advantages of shares, disadvantages of debentures, disadvantages of shares, advantages of debentures. So I'm going to start. The first advantage of a share is that dividends are only paid.
Yeah.
So it's an advantage because you have to pay dividends.
Yes.
Do you understand? Not interest. You are paying only dividends, not interest. That's an advantage. But for debentures, you have to pay interest. Interest must be paid.
Yeah.
Do you get the difference here?
Yes.
For debenture, if you have taken a debenture, if you have issued a debenture, it means you will be paying dividends and at the same time paying interest because you are a company, you have shareholders. But when you don't issue a debenture, it simply means you are just going to be paying dividends.
Yeah, dividends only.
That's the advantage. Okay. Do you get it?
Yes.
Dividends are only paid. If profit is made. Yeah. So you don't pay dividend if you are not making the profit because dividend is a share of profit.
Yeah.
But the problem about debentures here is that you have to pay the interest even if you are not making profits.
Yes.
Do you get the first one here?
Okay.
The second one, there's no requirement to repay the shares. There's no condition that you have to repay your shares.
Okay. No conditions at all.
No conditions.
Does not matter.
When you buy shares, no condition. But here they must be redeemed at the agreed date.
Okay.
So if your debenture has to be redeemed on the 1st of October, it has to be redeemed on the 1st of October, irrespective of whatever happens to your company.
Okay.
Do you understand? The third one, popular shares may be issued at premium.
Yes.
Another advantage about issuing shares or selling shares is that you can, if the demand for your shares increases, that might increase the price of the market price, and that means you can sell at a premium.
Yeah.
Then you have your share premium. Do you get that? Mm. But the problem about debenture is that it creates adverse gearing.
What's that?
It's there. Disadvantages. I told you I'm reading.
I know, but what's adverse
gearing?
What's that?
Adverse gearing means you are increasing your debts.
Okay.
Because gearing is about weighing your debts with your equity.
Perfect.
Hey, please, I'm talking here. You better listen.
Yes.
Gearing means weighing your debts with
weighing
your debts. Comparing your debts with equity. That is what gearing is. Comparing your debts with equity.
Okay.
So when you issue debentures, it means you're having more debts, and that will have an adverse effect on your gearing.
Okay.
Now, what are the disadvantages of issuing shares?
Okay.
Cost of making share issue is high. We talked about that before. When you have to issue shares, especially IPO, initial public offering, it is expensive. Administrative costs, commission that has to be paid, prospectus, and the rest.
Yeah.
So that's the first problem. But here it can be redeemed in the future.
Okay.
Debenture is not now. It could take longer period of year, maybe 15 years, 10 years to pay back. Yeah. So it can be redeemed in the future. That's an advantage of debenture there. Okay. So the problem of issuing a share is that dividends reduces the profit that remains with you. If the profit you make is still the same, the dividends would what? Reduce.
Okay.
So shareholders will not be getting high dividends if the profit they make previously is still the same.
Okay.
They have no voting rights. That's a problem about debenture holders. You have put money into the business, you are more like a creditor.
Yes.
But you don't have a voting right.
Okay.
Voting advantage here is that voting rights can be affected if new shares are issued. That's another problem when it comes to issuing of shares. You know, when you issue new shares, especially ordinary shares, it simply means that the voting rights that you have before would reduce.
Okay.
So that's the disadvantage about issuing of shares. Then the last advantage of debenture is that they will not be affected.
Yeah.
They will not affect equity dividends when there is increasing profit.
Yeah.
Profit increases, it's not going to have, it's an advantage because whatever happens to equity dividend does not affect the profit.
Okay.
Do you understand?
Yes.
Any question about that? So that's the difference between shares and issuing of shares and issuing of debentures. Is it clear?
Yes.
Good. So we have the creation and features of provisions. When we talk about provisions, we're simply talking about making a space in case of debt or in case of bad debts.
Yeah, okay.
That is why we have
provision.
So provision reduces the profit of a company and reduces the value of the assets.
And liability.
It reduces the value of the asset. It increases your liability.
Okay.
Have you forgotten that when you make provision for bad debt, if provision is made for bad debt, you take it away from your current assets.
Yeah.
And if you're taking it away from your current assets, it reduces your current assets.
Perfect.
Do you get the point I'm making here?
Yes.
So that's why provision reduces the profit of the business because it will be treated as, listen please, any provision will reduce your profit because it will be treated as an expenses.
Yeah.
And at the same time, it will reduce your current assets because you have to take it away from your debtors.
Okay.
Do you get it?
Yes. So you have to take away from your debtors.
So a company that is making sure that provision is made simply means it's following the principle or the concept of prudence, which means the company is representing a fair view of its financial position.
Okay.
That's about creation and features of provisions. Any question about that?
Yes.
Any question?
Okay.
Any question?
No questions.
Now we go to gearing percentage or gearing ratio. For gearing ratio, the formula is fixed cost capital, which is the debt, divided by the capital employed. Now capital employed is, we talked about capital employed before.
Yeah.
Total assets minus your liability times 100.
Okay.
Do you get it?
Times 100.
Times 100. That's how you get your gearing ratio.
Yeah.
Then when there's changes in gearing, what does it mean? There could be changes in gearing. And first, gearing, what is gearing itself? Gearing, I told you earlier, gearing compares a company total debts with its total equity.
Yes.
So gearing can change over time. It can increase or reduce. So if a company wants to increase, let's start from increasing the gearing.
Yeah.
If a company wants to increase its gearing, it has to issue more debentures. If you issue debentures, it means you are owing more debt. That increases your gearing. You have to issue more preferred shares. If you issue more preferred shares, it means you have to pay more in liability, current liabilities you have to pay.
Yeah.
It increases your gearing. Redeem your shares. If you are redeeming your shares, it means you are reducing your liquidity. That might also increase your gearing. In between, when you are redeeming your shares, please be here.
Yes.
When you are redeeming your shares, it simply means you might have to issue more debentures to finance your projects or expansion. Yeah. Because you have redeemed your shares. If you are redeeming your shares, it means you have few shareholders left.
Yeah.
And when you need capital, it means you have to take a loan.
Okay.
So this situation will increase your gearing.
Okay.
Issue debentures, issue preferred share, redeem your shares. When you do these things, it increases your gearing.
Okay.
Then how will a company reduce its gearing? To reduce your gearing, you issue new shares.
Okay.
Not preferred shares here. You issue new shares, that's ordinary shares. You retain your profit rather than paying dividends. You don't pay dividends.
Yes.
Because when you pay dividends, it reduces your liquidity. And the last one is redemption of debentures. You redeem your debentures.
Perfect.
So when you redeem your debentures, when you issue new shares and you retain your profit rather than paying dividends, it reduces your gearing ratio.
Okay.
Any question?
No.
So that ends debentures and
Unit 2 capital structure of limited company.
that ends debentures and share. Thank you. And that's capital structure of a company.